Today we'll be explaining what an exchange-traded fund or ETF is, how they work and why they are such an effective and therefore popular strategy when it comes to investing, with new and seasoned investors alike both making good use of them. We'll dive right in. Simply put, an ETF is a fund akin to a big pie containing shares of individual companies. These funds pool together investors' money and are accessible to individual investors through stock exchanges, just like the stocks of the individual companies themselves. Therefore, ETF quite literally means what the name says. They are funds which are traded on an exchange. One ETF can hold thousands of different stocks, while some hold much fewer. Spreading capital out amongst a wide range of companies helps to reduce exposure to risk. ETFs can also contain other assets like commodities or bonds, but for the sake of this video, we'll be talking mainly about shares. Investors can see returns from ETFs in one of two ways, the main one being through capital appreciation on the open market. This is how much you could sell your shares in the ETF for. It's important to remember that these gains, or also losses, are only realized when you sell your shares. The second way is through dividends. Not all ETFs pay dividends, however, so it's worth checking an ETF's dividend yield and historic distributions to be sure. There are ETFs that focus on dividend-paying companies if this is something that appeals to you. The most common ETF example is one that tracks the S&P 500, an index of 500 US companies with the highest market capitalizations. Such an ETF comes highly recommended by many for the average investor. Each index fund publishes their holdings, and this information can be useful to understand exactly what you are buying, especially for industry-specific funds. Vanguard are one of the most popular ETF providers, and their S&P 500 ETF is heavily weighted towards the most successful companies, with the 10 biggest holdings of the fund making up almost 30% of its value. At the other end, we can see the 10 smallest holdings making up a tiny proportion by comparison. Investing in an ETF like this may be less exciting than picking individual stocks, but the results aren't to be laughed at. A hypothetical $10,000 investment in 2011 would be worth almost $46,000 now, with an average return of almost 16% per year since this particular fund was created in 2010. When factoring in research from S&P Dow Jones Indices, which found that over a 10-year period, 85% of large fund managers underperformed compared to the S&P 500 benchmark. This increased to 92% over 15 years, which I think is quite eye-opening. These are large fund managers, by the way. Investing is their job, so we can probably presume that the chances are even worse as a retail investor. One of the oldest ETFs tracking the S&P 500 has increased by 622% since its inception in 1993 to the December 2019 price of $321. That is 23% per year, comfortably beating inflation. And that's not even accounting for the incredible growth we've seen since the trough caused by COVID in early 2020. Some people would argue the current price is too high, and it's only a matter of time till we see a downward correction in price. But we can see that over time that isn't really too relevant. With an investment like this, it should be set and forget style for 10 years plus as a minimum. If the price drops in the short term, great. That means you can buy more at a low price before the inevitable rebound. Of course, it's preferable to buy after a dip in price. You can buy more shares. But on the other hand, if you never buy, waiting for a dip that never comes, you're losing out on potential gains. The saying time in the market beats timing the market is definitely relevant here. Even in a catastrophic scenario where we see a total collapse of American society and Western capitalism as we know it, it probably wouldn't matter too much what your investment portfolio was worth. If this is a specific concern of yours, you can of course buy ETFs outside of the S&P 500 in America, with ETFs existing for pretty much everything, in other countries, across multiple countries, or the entire world. They also exist to target specific industries or even to exclude companies perceived as being unethical, among other reasons. But for the common individual, that's probably getting all a bit more complicated than it needs to be as a starting point. If a simple S&P 500 ETF is good enough for Warren Buffett, it's probably good enough for most of us. For those of you wanting to buy an S&P 500 ETF, the previously mentioned supplier Vanguard has a low fee, and their funds can be purchased through their own platform or are widely available on other platforms too. If you do purchase through an app or online broker, I would just be careful you are purchasing the one that you actually want to, when there are so many with similar titles. With ETFs, we have two types, the first being accumulating, meaning that dividends are reinvested automatically, and the second being distributing, meaning that dividends are distributed as cash payouts. They are also available in many different currencies. It can be preferable to purchase one in your own currency to avoid exchange fees and volatility, and distributed dividends are useful to get the cash if your account won't incur tax obligations by doing so, such as an ISA in the UK or a 401k in the US. If your account would be liable for tax on dividends, an accumulating fund is probably preferable, as dividends are automatically reinvested and not distributed to your account. You may have also heard of mutual funds. They work in a similar way, but are not traded publicly. You have to buy into the mutual fund's investment portfolio privately. Also, it trades usually just once a day after the market has closed and settled. Generally speaking, most people think that an ETF is more transparent, more tax efficient, and that they provide greater liquidity when compared to mutual funds. So I think we've covered how they work and their historic performance. So let's look a little bit more at why they are so popular. The first main reason is risk, or more accurately, the lack of risk. If we buy just one stock, we are massively exposed to the price volatility of that single stock. Of course, this can be a great thing. Just think about Tesla, trading at just under $50 5 years ago and now up nearly 2,000% to its current price. Even if you're a total beginner when it comes to investing, I'm sure you've still had exposure to a variety of creators highlighting individual stocks, myself included. But how realistic is it really to successfully identify the next Tesla that can explode in price like that? While such growth certainly has been made on stocks like Tesla by many normal retail investors out there, the truth is that for most people, they simply can't stomach the risk of putting a vast portion of their savings onto a single stock. Someone would have had to have invested about $50,000 5 years ago in Tesla to be a millionaire today, and that's not even taking into account any taxes that would be due. Owning these growth stocks can certainly play a part in any investment portfolio, especially for younger investors who have the time to see if they can come to fruition. But many will use a major part of their portfolio in ETFs to reduce risk. If we again use the S&P 500 as an example, the 500 companies within are present across a wide range of industries. So if tech stocks have a bad few months, this could be offset by good performance in other market segments such as infrastructure. We will still of course be exposed to market risk. If the American economy experiences a bad few months, your investments would of course still suffer. The second main advantage of ETFs is reduced fees. When the first ETFs appeared in the early 90s, they were by far the most efficient way for investors to replicate market returns. ETFs charge a fee called the expense ratio, and this covers the cost associated with administration, portfolio management, marketing, and any other costs related to running the fund. They are passively managed, automatically replicating the index that they track. The Vanguard S&P 500 ETF has an expense ratio sitting at just 0.03%. This represents a huge cost saving when compared to other ETFs in this category, although there are now some available with fees even lower. Mutual funds, which we mentioned earlier, do a similar job, but they have a higher expense ratio. This is because they are actively managed by a fund manager who obviously charges for their services. And remember, these fees take a cut of how much you have invested, meaning you have to pay this whether the fund has made a profit or a loss. And when 92% of fund managers don't outperform the market over 15 years, it's a bit of a kick in the teeth to then have to pay a higher fee for the privilege. Fund managers and financial advisors do still serve a purpose, especially for higher net worth individuals who can make good use of their expertise on tax matters, among other things. ETFs also save on transaction fees, as you are effectively buying many organizations in one single transaction. This makes them more accessible than traditional stocks. If you're investing little and often, it's much easier to buy fractional shares in one ETF rather than buying tiny amounts of many stocks. And finally, we of course have the convenience that ETFs provide. You don't have to take as much time out of your day to research your holdings and stay up to date on individual companies. You can literally just set a monthly transfer up from your bank account and forget about it. And once you get going, it's a good feeling watching the numbers climb up, apart from those times when obviously they don't. While I totally understand why Warren Buffett recommends individual investors to just play it safe and lump your money into a low-fee ETF to replicate market performance, there is of course a naively optimistic part of me that thinks I can pick individual stocks that will outperform the market in the future. Especially as I'm still in my accumulation phase in my investment journey, I feel comfortable taking some risks on growth stocks that I truly believe in. So personally, I use a combination strategy, choosing individual stocks for potentially high growth, whilst using ETFs to basically provide insurance for myself. It would be incredibly brave or stupid for me to just go 100% into growth stocks. Over time, I will be very intrigued to see how my individual picks perform compared to my ETF investments. So ETFs are great for beginners. You get an idea of how investing works, and it gives you a chance to learn about other topics within the field. And you will likely make steady returns here whilst you decide if you want to delve any deeper into the world of investing. It will also help to build good saving habits and routines, which are crucial on the road to becoming financially independent. Please drop a like if you enjoyed the video, comment down below with any topics, questions, or stocks you think I should take a look at, and subscribe for more investing content in the future.